Rich, I mean, you see this skepticism seeping into the AI trade, or at least the market trying to sort relative winners and losers. How does it leave you treating it, the tech trade?
So look, the AI anxiety is continuing. That was caused by, obviously, the circular financing, the leverage with Oracle, the questioning depreciation schedule, and the stretch valuations, none of which concern us. Because what we're looking at is companies that have had outstanding Q3 results. The market will continue to move them lower until a point where operating cash flows become very attractive. And we're actually very close to that right now. Specifically, if you take the three hyperscalers, Amazon, Google, and Microsoft, the operating cash flow as a percentage of the market cap is now roughly equivalent to the 493 stocks, the non-FANGs in the market. So we can talk about Bitcoin affecting the large cap tech stocks, but you can't argue with the growth in the hyperscalers last quarter and their operating cash flows right now, which will ultimately set a floor on these stocks.
Although the operating cash flows have never been the question. It's what they're doing with the cash flows, right? So the free cash flows is what's been going down because they are investing so heavily.
So if I'm the CFO of Microsoft or Google, and I've got $180 billion in operating cash flow for next year, I'm going to invest $110 billion back into CapEx. What are my choices with it? I return it to shareholders, I put it on my balance sheet, 4% risk-free, or I reinvest it. Okay, they're reinvesting it, and look what happened year over year. We had 39% growth in Microsoft's earnings, 34% in Google, and 20% in Amazon. So the decision to reinvest these large amounts is scaring everyone, yet we're seeing huge increases in the growth of the earnings and the operating cash flows.
And Rich, if you're not concerned big picture about kind of the financial condition of these tech companies, which of course is pretty bulletproof up to this point, what are you doing tactically with your clients? I mean, have you taken profits in those areas? Are you looking to park cash? How does it feel going into the end of the year?
Well, we begin with the end in sight. So we'll target a rate of return with each individual client. Let's call it 7%. And with that, we'll build an asset allocation. Now, as Courtney mentioned, we've had years of growth on the equity side, which means that we've got to continually pare back the exposure to equities. It just so happened that no one loves municipal bonds anymore. And munis, and listeners have known, I've been a big proponent of munis over the last year, where we're getting 4.5%, 4.75% tax-free in munis. So what we've been doing is tactically reducing equity, which has been growing enormously, and reinvesting into the safe side of the asset allocation, which if we're getting 4.5% tax-free, that takes us a long way towards the end in sight, which is 7% for that particular client. So we're adjusting asset allocations, we're maintaining our technology overweight, along with some other sectors, and we're adding municipal bonds. We have added quite a bit.
Okay.